Happy Friday, traders, and welcome to another installment of The Big Picture, where we take a look at the central themes driving the financial markets and try to put them all together in a way that makes sense. I'm your host, Neil, and the word of the week is inflation. Actually, the words of the week are inflation expectations, which, in my opinion, are even more impactful on short-term price moves in the stock market. So we're going to talk all things inflation, some recent economic data points that came out related to inflation. We'll go over the current intermarket trends and talk about the other things that mattered this week in the financial markets. But before we do that, do me a favor, don't forget to subscribe to the channel. Hit the subscribe button there. The little bell icon within the subscribe button will give you notifications. So every Friday when we put out another episode of The Big Picture, you'll get a notification in your inbox. With that, let's dive in, and I'll see you on the other side. Jumping right into the current intermarket trends this week, we'll start with U.S. equities, still in a prevailing long-term and mid-term uptrend. But this week we saw some volatility. We saw a quick sell-off and then a two-day bounce into Friday morning today. So near term is basically flat on the week. Range rank at 12% tells us that equities broadly have moved from the top of the range down towards the bottom of the range until yesterday's bounce and into this morning where we're moving back towards the middle of the range. Range rank of 12%, that's of the close Thursday. So, let's take a quick look at the chart here and see what's going on. So we're looking at SPY here, just a proxy for the broad markets, right? Looking back to Wednesday, we see this big red candle, moving below the bottom of the range. So even on Thursday's bounce higher, it barely brought us up above the low end of the range. So that's where the 12% range rank is coming from. Obviously moving higher today on a continued bounce. So moving back towards the middle of the range, that range rank is going to be a little different for the week's close come the close of today, Friday. But we also see that the drop here was met with a spike in volatility. Now, if we pull the chart back a little bit, we can see that volatility on a relative basis is still pretty suppressed, right? So that's important to think about. But volatility did spike on this recent move down, as did volume. So price moving down with volume moving up into that price move down and volatility moving up. So some definite caution signs here in equities broadly, especially considering that on this the recent bounce yesterday and into this morning, we're getting that on decreased volume and a continued spike in volatility, right? So I'm not necessarily convinced of this bounce yet. It's still pretty early today, Friday, so this big bounce higher is definitely a good sign. So far, it's on reduced volume. We'll see what that volume looks like at the end of the day, and volatility has continued to spike higher. So what I'd like to see by the end of the day to be a little more convinced of this pop higher is, price maintaining its current level or continuing higher on increased volumes, in particular if volatility comes out a little bit. So let's take a little bit closer of a look at volatility across the market index. All right, so here we have the VIX, which measures the volatility of the S&P 500 looking forward, right? So implied volatility 30 days out. We see that on a relative basis to last year, volatility in the S&P 500 still relatively suppressed. But we keep getting these volatility spikes, and that's exactly what we saw this week. Particularly, we saw volatility move from sub 20 to back above 20. Now, when VIX is below 20, I think of that as kind of the bull's bucket, right? That's where prices tend to trend higher, and generally it's a lot easier to make money. Whenever the VIX is between 20 and 30, that's considered the chop bucket, right? So there's a little more volatility. The market is a little more fearful. It's definitely a little more uncertainty in equities broadly. When the VIX gets above 30, that's the oh shit bucket, right? Where crazy things can happen. So right now with a current VIX reading of 23.13, we're in the low end of that chop bucket, right? So we saw that spike higher in volatility this week with that price sell-off. And here in a few minutes, we'll talk a little bit more about what caused that spike in volatility and the correction earlier this week and why we might be bouncing higher today. But before we do that, let's take a look at some of the other equity indices. Turning to the market watch list here in the bear matrix, we got the NASDAQ ETF. So that's the Qs, right? QQQ, closing down 2.5% on Thursday. So a continued decline in the NASDAQ ETF and generally just the air continuing to come out of the NASDAQ. I mean, down 7% over the last month, the trailing month that is, almost 5% over the last 3 months. So that midterm trend definitely down. You got to go back to the 6 month or 12 month to see a positive percent return here in the NASDAQ, which again is kind of a proxy for the technology companies here in the United States. So current range rank below the low end of the range at negative 18%. So a big sell-off that's likely overdone as of the close Thursday. And we're seeing that big bounce today. So we'll take a closer look at today's chart as well. Volatility ranked 17% as of yesterday. So not a huge vol explosion relative to where it's been the last year, right? So that vol rank looks at volatility over the last year. So we're still seeing some of the craziness of 2020 reflected in the fact that we got a vol spike this week, but it's only a 17% vol rank because there was crazy stuff happening within this last year. So we'll take a closer look at the VXN, which is NASDAQ volatility. So again, same story here where relative to where it's been in the last year, volatility in the NASDAQ is still rather suppressed, but we definitely got a spike higher here in the near term. So let's drill in a little bit closer so we can have a better look at that. Yeah, I mean, volatility breaking out above the top end of its range, moving to near 30 in the NASDAQ. Now, the buckets aren't exactly the same in the NASDAQ, where sub 20 is the bulls bucket, 20 to 30 is the chop bucket, 30 and above is the oh shit bucket. They're a little different here in the NASDAQ, but in general, we're seeing a big vol spike in the NASDAQ. Came out a little bit yesterday on a continued move lower. So let's have a look at today's chart in the Qs. We'll cruise down to the technical analysis section, dial in QQQ here. Yeah, so we're seeing a solid bounce today, but we did see this price decline on increased volume and increased volatility. So I'll be interested to see how it closes today, see if this bounce higher in price can hold through the close. I'd like to see that on increased volume and a decrease in volatility. And so this is historical volatility we're looking at here as opposed to implied forward-looking volatility. But same story there, where we're really low within the range of where volatility has been within the last year, but we did get a near-term spike. So continued caution signals in the Qs as well. Turning to the Russell 2000 ETF, IWM, right? That's kind of the proxy for small caps, domestic small caps, that is. We saw yesterday a big decline, really getting at the worst on Thursday, down 3.2%, down 4.67% on the week, and pretty much the same over the month. So small caps in the near term struggling the most with this most recent correction, right? Looking at the midterm in small caps, much like the NASDAQ, is where we're seeing that inflection point where 3 months down 6.5%, but 6 months still up 25%, even with all this near-term weakness, and 12 months up 67%. So small caps really still continuing to do well in the long term and midterm, but at this inflection point at the short side of the midterm and near-term weakness. So small cap struggling along with tech this last month or so. S&P 500 again broadly not doing nearly as bad over those time frames. In fact, up over the last 3 months. So we're seeing some bifurcation in the market, right? Where certain corners of the market are doing well, certain corners of the market are struggling a little more. This recent correction, I think, kind of brought us to the low end of the ranges in all of the market indices. So we'll see if this picks up steam and continues lower, or if we form a low here and the market pushes higher. I'm more convinced that the market pushes higher here because some of the near-term headwinds are going to get out of the way and some of the fear is going to come out of the market. And I think we're due for another leg higher. So let's turn to some of the economic data. Specifically, I want to focus on inflation this week and talk about the market's reaction to recent inflation-related data coming out Wednesday and Thursday. And why I think it's a little overdone, why I think it's going to get worse before it gets better, but eventually it'll get better before it gets worse again, right? So let's talk about it a little bit. So the big news out this week was inflation data, right? I mean, we also had our man Elon talking about crypto, and that was a whole other thing, but we're going to focus on economic data right now. So we had headline CPI out on Wednesday coming in at 4.15% increase year over year. So relative to this time last year, consumer price index, which is a central measure of inflation here in the United States, up 4.15% on a relative basis. It's also accelerating sequentially. So this month compared to last month, we're accelerating. Let's take a quick look at that. So jumping into the economic data tab here in the bear matrix, right away it stands out, this huge move higher, this kind of big scary bar at the end here. CPI accelerating 4.15% year over year. Let's see if I can get this to pop up. There it goes. So a substantial move higher year over year, but that makes sense because this is looking back to April of 2020. Yes, it's a scary move higher, but it's because, or at least partially because, we're looking back to easy year over year comps. What we're going to find is over the next couple months, those year over year comps are going to get harder, right? So right now we're looking back to April. I mean, this is the April bar right here. You can see that on a year over year rate of change basis at that point, we're up 0.34%. So the value line here, that's the white line. That's the actual value of CPI. We saw a huge dip in the wake of the coronavirus fallout. At the same time, the blue bars here are the year over year rate of change. So we see that rate of change really coming out into the coronavirus fallout. Picking up and trending higher ever since then, both the nominal value and the year over year rate of change. So now we're seeing the first comparison to what was the first really bad month of data in 2020. So yes, the most recent data point is obviously a big rate of change, a big acceleration higher, right? And so I get why that spooks the market, but you have to consider where we're coming from. Again, that easy year over year comparison, and you have to consider where we're going. Year over year comparisons are only going to get harder from here. So into June especially is kind of the first month where it starts to tick higher, and all through the summer to the early fall, we're going to get harder and harder year over year comparisons. And the same thing's happening here in the producer price index. Now this is specifically looking at the producer price index for all commodities because we've been seeing commodities continue their push higher. But same thing, this growing, accelerating trend to the upside. Now, the producer price index measures the input cost for producers of consumer goods, right? So when this pushes higher, it indicates that prices for consumer goods are likely to trend higher as producers of those goods pass the increased price of commodities and the basic materials that go into production of those goods, pass those on to consumers, right? So definitely another measure of inflation here with the PPI. And obviously this is accelerating as well, but we see that relative again to this time last year, we have really easy year over year comparisons that let's see, what month are we looking at here? This is the lowest bar, so that's April. So this is really the worst month of that year over year comparison. It's going to be the most inflationary looking because of that easy year over year comp. That trend is only going to get easier for us as far as the comparison is going to get harder. So inflation is not going to look nearly as bad moving forward. And that trend continues throughout the summer. Couple that with the fact that right now we have some continued supply chain disruptions and bottlenecks, specifically with commodities. And that has to do with a labor shortage and demand coming back and some sector specific bottlenecks that have occurred, namely like the Capital Pipeline for oil, things of that nature. So what I think is that some of those supply chains are going to start opening back up. We're going to start getting more difficult year-over-year comparisons. That's going to put a lid on this acceleration in inflation. So I think throughout the summer, we're going to see commodities start to cool off. Commodities prices start to cool off. That's going to start to curb inflation fears. And as the inflation data moving forward hits those harder year-over-year comparisons, it's not going to look nearly as scary. So all of those things combined, in my opinion, lead to investors' expectations of inflation cooling off and the market pushing higher once more. So what's the deal with this inflation, and why does it matter so much? Well, as we've talked about the last several weeks on the big picture, the narrative driving that is that the more inflation accelerates, the more likely the Federal Reserve is to discontinue easy money policy and potentially raise interest rates, right? So the Federal Reserve is still deploying two tools in order to support the economy and to keep a lid on interest rates. So namely, they have the asset purchasing program, where they're currently purchasing about $120 billion every month in both U.S. government treasuries and mortgage-backed securities, right? So that has the effect of injecting liquidity into the economy and supporting economic growth, the economic recovery. They also have the Fed funds rate, which is the short end of the yield curve. So they can set very short-term overnight rates, and that has kind of a cascade effect for market interest rates. So the fear is that as inflation picks up, the Fed is less likely to continue its support of the economy and to keep deploying tools to keep interest rates low. So the first thing that would happen is the Fed would likely start to taper its asset purchasing program. So start buying less, maybe stop buying completely U.S. government treasuries, mortgage-backed securities. Then the next thing that would happen is they might start to raise interest rates, to raise the Fed funds rates, which again would have a cascade effect, raising interest rates across the yield curve, across all timelines. So that's the fear, that inflation accelerates, forcing the Fed to discontinue easy money policy, to discontinue putting a lid on interest rates in the ways that they can. So the next logical step is, well, why do interest rates matter so much? When interest rates rise, it puts a lid on growth-oriented companies, because growth-oriented companies have a harder time being profitable in higher interest rate environments because the debt that they use to grow their businesses becomes more expensive to service. And those interest payments on the debt that they take out to grow their businesses become more expensive. They increase, and that puts a lid on their profitability. So generally, the narrative is that higher interest rates reduce growth and reduce economic growth broadly, specifically in high growth-oriented companies like the technology sector, right? So elevated inflation expectations over the last few months have really put a lid on the technology sector in particular. So we've seen technology consolidating over the last couple months as yields have more or less been on the rise, and more broadly, inflation expectations have been elevated. So what I think is going to happen is that these inflation fears are going to subside as it starts to look less bad moving forward. And I'm talking about the next 2, 3, 4 months, right? And when that happens, I think technology and growth-oriented companies are set to make a comeback. Now, I could be wrong, but I think that's what the data is telling us the higher probability outcome is in the very short term. With that said, I think that the deep fiscal deficits that the government's running, coupled with extreme monetary support, easy monetary policy, those things coupled together are going to lead to increased inflation moving forward into the future. It's just that in the very near term, investor expectations of inflation are a little overdone. They're a little too fearful of inflation accelerating. There are too many headwinds that are about to subside. So it seems to me that right now we're at the worst of it, right? There's all of this kind of confluence of things happening, making inflation look as bad as I think it's going to look for at least the next couple months. Again, easy year-over-year comparisons, supply chain disruptions, all of those things likely to get better, not worse, into the next couple months. So at the extreme right now of, in particular, investor expectations of inflation. And again, the main fear is that the Fed does something about it, that inflation starts to get out of control, so the Fed is forced to fight inflation by way of, tapering their asset purchases or raising interest rates, or both, right? So, but the Fed has come out continually saying that they're not ready to do that yet, and that's not something that's likely to happen for at least several months. The main thing that they're looking at is, employment data. So again, the dual mandate of the Federal Reserve is to promote maximum employment and stable prices. So we had some surprisingly weak employment data out last week that significantly reduced the likelihood of the Fed doing anything about inflation in the near term, right? They're still focused on jobs, coupled with the fact that they've come out saying continually that they're going to allow inflation to run hot. Also, the Fed believes that this near-term inflation is transitory. While I hate to agree with anything Federal Reserve related, I tend to agree that in the short term, I think inflation is going to look better and not worse. I think in the long term, it ends up creeping in higher and higher because we still have this huge fiscal deficit we're running and are likely to continue running and even deepen. And this extreme monetary support, devaluing the dollar and generally creating this kind of bizarro world, right? This inflation narrative could persist, for several more weeks, if not another month or two. First of all, we don't get the real gauge of inflation that the Federal Reserve cares about until May 28th. That's the PCE, the personal consumption expenditures. So, the market might continue doing exactly what it's doing until we get past that big economic data point. And that's likely to look bad as well, because again, looking back year over year, difficult comparisons. So inflation in general is going to continue to be a big part of the narrative. It's going to be a big focus for investors and have a huge influence on the stock market. Again, it's going to keep, until we can get that inflation fear to subside, it's going to keep a lid on growth and technology and the stock market broadly. But I think that whether it happens next week or 2 months from now, inflation expectations are going to cool off and it's going to give a tailwind to the market. The growth picture still looks outstanding. So, more generally, economic data is looking positive. And the narrative has just kind of shifted to where we were scared of not enough growth and the economic recovery waning just a couple months ago, and now the fear is that economic growth is improving to such a degree that inflation creeping in is more of a fear than growth not happening. But again, I think inflation fears are going to subside as growth continues higher, and it's going to push the market higher. Digging into the sector rotations this week to get a better handle on what is moving within the market, we can see it's pretty much upside down week, right? This is the 1 week return up here, everything down. Staples might be pretty much flat, but technology and discretionary and communications in particular down. And that again alludes to the growth story. Those are the growth oriented sectors of the economy. So they tend to do worse in rising interest rate environments. In particular, they do worse whenever investors' expectations of inflation are on the rise. So always about expectations, right? So we see technology, discretionary, communications performing the worst. Metals and mining, energy, industrials, financials. Those have been the best performing sectors over the midterm, long-term trends. So they're kind of in the middle of the pack this week as the market generally rotated into the safety of staples, healthcare, and utilities. Materials outperformed a little bit as well on a continued uptick in higher commodities prices. So basically, we just spent 10 minutes or so talking about inflation, and all of that relates exactly to what's happening in the sector rotations this week, where the fear really picked up of inflation this week, and that had a direct impact on the flow of funds through the market, right? So a rotation into safety, a rotation out of growth, underperformance by the sectors of the economy that have been performing the best over the mid and long term. So again, looking at the 12-month and 6-month, we see metals and mining, financials, industrials, energy, materials really leading the market higher in the long-term, midterm. So it's this short term, the 1 week and 1 month move that is, we're seeing a little bit of an inflection point, and that's because this changing narrative around inflation. So I could say it 100 times, but the chart really says it all. This is where the rubber meets the road. This tells us exactly how funds are flowing in the market, and this week it's saying that investors are fearful of growth because they're fearful of inflation, and they're moving into safety right now. As those inflation expectations cool off, I'd expect a rotation back into the sectors of the market that have performed the best over the midterm and long term. However, one of the main drivers of metals and mining and materials in particular, and their outperformance over the midterm, long term, has been this run higher in commodities, right? Commodities has been a great place to have your investing dollars the last year. I know that's where I've made the most money the last 12 months, 14 months, I guess, at this point. And unfortunately, we're kind of running out of time. Otherwise, I'd love to show you guys the extreme bullish market consensus positioning in commodities broadly and specifically in certain commodities. So if you guys subscribe to the Bear Matrix, check out the market positioning page and check out some of the positioning in commodities, because it's getting pretty overdone. Extreme bullishness telling me from a contrarian perspective it might be getting overdone. Couple that with the fact that some of these supply chain disruptions, namely the labor shortage and specific, like sector specific supply chain bottlenecks, those are going to start to ease. So that's going to put more downward pressure on commodities prices. So those a handful of factors that I think are going to get better, not worse, and they're going to provide a headwind for commodities prices. So that's going to have implications for the next couple months as far as the sector rotations are concerned. So those are kind of your key takeaways. Really thinking about investor expectations of inflation, how those are likely to change over the next few months, given changes in economic data, year-over-year comparisons, supply chain disruptions. So I'd be thinking a lot about those things and trying to figure out what the next move is and how the market is likely to respond to any moves and which sectors of the market are likely to respond to that. That's all I got for you today, folks. As always, plenty of stuff to be thinking about, plenty of opportunity presenting itself. Keep an eye on inflation expectations, consider the impact that's likely to have on the various sectors, and position yourself accordingly. As always, thank you guys so much for tuning in. Don't forget to hit that like button, subscribe to the YouTube channel, check us out at marketbarometrics.com, where you can get access to all of our software tools and start performing your own market research. We've also got a ton of free educational content there so you can start learning and developing your skill set. Until next week, I hope you all have a fantastic weekend, and we'll see you next Friday on The Big Picture.